Hello! Thank you for surviving to the last video. I know there's been quite a few. There's a lot to go over in inventory, so glad you're still here and watching this one. We're going to just quickly look at the last thing related to inventory, which is a way that we can estimate our ending inventory. And we are only going to look at the gross margin method. So don't worry about covering the retail method. It's a little more complicated. We'll just take a look at the gross margin method. So this method can be used when you're unable to or you don't want to do an inventory count. So let's say that there was a fire at the end of the year or sometime during the year and your inventory burned, but for your insurance purposes, you need to come up with an estimate of how much inventory you had. So you could use this method. Or it could be used to prepare interim financial statements. So if you are a company who uses the periodic method, but you don't want to do a count every single month, yet you want to prepare interim statements, you need to know your updated inventory. So you could use this amount and estimate it that way. This method uses the company's average gross margin percentage, so we looked at that in the last video, and it uses that to calculate what the estimated cost of goods sold is. And then once we estimate cost of goods sold, we can estimate or calculate what our ending inventory is. So this is step one. We estimate the cost of goods sold first. So you have to figure out what your cost of goods sold is by using this gross margin. So if we take our sales revenue and multiply that by the gross margin percentage, it gives us the amount that we think we keep at the end. So that's our gross margin essentially. So doing this step calculates your gross margin. When you take away the gross margin from your sales revenue, that gives you your estimated cost of goods sold. Because we know sales minus cost of goods sold equals our gross margin. So we calculate gross margin here, subtract it from sales, and we're filling in the blank here with our cost of goods sold. Or another way that you could think of this is to figure out here what percentage your cost of goods sold is, essentially. So our gross margin percentage, that's the percentage that we keep of sales in gross margin out of 100% of sales. Therefore, the other missing percentage, if we take 100 minus your gross margin, that's the percentage that is in cost of goods sold. So if we figure out what the percentage of cost of goods sold is, we can then multiply that by sales revenue, and we're calculating our cost of goods sold that way. So once you've done one of these methods, you then use it here, change the order of our calculation for ending inventory. We're just swapping those from how they normally are when we are calculating cost of goods sold under the periodic. So we get to our cost of goods available for sale, subtract the estimated cost of goods sold that we calculated here, and then we get to this estimated ending inventory amount. Let's go through an example because I think it will become more clear when we see some numbers here. So in this example, we have sales revenue of $100,000 and our average gross margin is 40%. So we would have this average from the last number of periods. So every time we do financial statements, we calculate the gross margin percentage and we can figure out the average that we've had over the past number of years. We also know that our beginning inventory is $14,000 and we have purchases of $66,000. So when we add those, we get to our cost of goods available for sale. Now we need to do the first step, which is to estimate our cost of goods sold. We'll then subtract that to get the ending inventory. So as I said here, we're going to use this first formula. So we have our sales revenue, which we know is $100,000. And we're subtracting our sales revenue times the gross margin percentage. So we're calculating the gross margin and we're subtracting that from sales. So we take this here, it's 100,000 times the 40% gross margin percentage, and that gets us to 40,000. So that's our gross margin. We need to subtract that from our sales revenue, and therefore our estimated cost of goods sold is 60,000. So now we use that to calculate ending inventory. So if we had $80,000 of goods available for sale and we sold 60,000 of them, we can estimate that our inventory is at that $20,000. Okay, so that's just a way that you can go through and estimate if you don't want to do a count or if you're unable to for some reason like a fire. All right, so that is the end of our inventory. 2 chapters on inventory. I know there was a lot of information. The biggest focus in these videos was how to figure out the costing methods. So knowing your FIFO and weighted average cost and how you fill out those tables and the information from those tables, as well as knowing how to use the specific unit cost method and actually picking out each specific unit and the cost that goes with that.